Dennis Tubbergen here with another economic update. Today is March the 7th, 2018. I want to talk to you today about what I call the coming pension storm. I wrote a piece about this in my January newsletter. And I have on the screen in front of you here a Bloomberg article that talks about this. And the article talked about the fact that the median funding ratio, the percentage of assets states have available for future pension payments to retirees, declined to 71.1% of assets needed to pay full pension benefits in 2016. That's down from 74.5% in 2015 and 75.6% in 2014. So let's go back and look at this. The median obviously means half the states are above that level of funding, half the states are below that level of funding, and the median funding rate is 71.1%. Now you've got to keep in mind that this decline in pension funding is in spite of a near record bull market in stocks. Now, this probably doesn't mean too much to a lot of folks unless you're going to receive a state pension and unless you know how underfunded your particular state is. Well, if you just take a look at the states that there's only one pension plan, incidentally, in the country that is fully funded, and it's Washington, D.C. at 100.5%, not surprisingly. New Jersey's pension is funded only to 30.9%, about 31% of the assets needed to pay promised pension benefits. We've got Kentucky, not much more than that. Illinois, those are all in the 30s. Connecticut and Colorado are funded to 41 and 46% respectively. And many states are in the 50 and 60% range, among them Alaska, Vermont, New Hampshire, North Dakota, Montana, Michigan, Massachusetts, Rhode Island, Indiana, Pennsylvania, Maryland, Arizona, New Mexico, Kansas, South Carolina, Louisiana, and Alabama. So what's the bottom line here? Well, in my view, the bottom line here is that if you're receiving a state pension or are promised a state pension in one of the states I just mentioned, we're likely going to see cuts coming at some future point. I'm not saying they're imminent, but based on the math, I'm saying they are likely inevitable. Now, we don't know what form or shape these cuts might take or which pension plan recipients might be affected, but the simple truth of this is this: if there's not enough money in the checkbook to pay all the bills, not all the bills will get paid. Now, I could talk a little bit more about this, but just to put the New Jersey pension plan into perspective, the total underfunded pension amount for both state and local pensions is more than $66 billion. The total population of New Jersey is just under 9 million, so that means that every man, woman, and child in the state of New Jersey needs to kick in $7,400 to fix this problem. And that doesn't count underfunded liabilities at the federal level. It doesn't count national debt. We have a significant debt problem. Now we're seeing some pension plans that are underfunded address the issue. There was a story published talking about Don Carden. Don Carden was the retired fire chief of Central Falls, Rhode Island. He retired in 2006 after 22 years of service. He was collecting an annual pension of $38,000 when he retired. However, after the city declared bankruptcy, he took a $16,000 hit in his pension. He now gets $22,000 a year in pension benefits. There were similar cuts when the city of Detroit declared bankruptcy to those municipal pension plan recipients or participants. Now, there's another story about iron workers in Ohio. I had highlighted a gentleman by the name of Larry Burrell. Mr. Burrell saw his monthly pension decline from $3,700 to $1,600 again after he was retired. He was getting $3,700 a month, which is a pretty fair income, about $45,000 a year, and it was cut to about $20,000 a year, so about a $25,000 cut. Now, Mr. Burrell was a member of the Cleveland Iron Workers Local 17 pension plan. And in just 1 year, in 2017, the United States Department of Labor listed 143 different pension plans as being endangered, critical, or in declining status. Now, there are many of these union-sponsored pension plans that have filed to cut benefits for existing recipients. Now, you might be asking, how can that possibly happen? Well, there was a law passed in 2014 called the Multi-Employer Pension Fund Reform Act. And Mr. Burrell is not a big fan of the law. In fact, he said in the article it was run through Congress in the dead of the night, and President Obama, who is supposed to be for the working class, signed it. The Multi-Employer Pension Fund Reform Act allows pension plan sponsors to propose pension benefit reductions to the Treasury Department. If the Treasury Department approves the proposed cuts, the reduced benefit recommendations are submitted to plan members, both active workers and retirees, for a vote. Unless more than half the membership votes against the reduction, it goes into effect. Now, it's important to note that this vote by the members is not a straightforward count of yes and no votes. Rather, it's a vote of the percentage of the membership that actively voted no to the cuts. That means that a member who doesn't bother to vote is actually voting yes. So look for this pension underfunding problem to consume headlines and dominate headlines here over the next couple of years as these debt levels come to a head. And look for significant economic repercussions. We believe that holding 10% of your portfolio in precious metals is a good consideration and a good place to start. I'm Dennis Tubbergen, and that is the video economic update for today, March the 7th, 2018.